Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at WBD, Warner Brothers Discovery, Q2 earnings are out, and they are bad. They are bad, that's all there is to say about that. I do own shares of this company, not super happy with the results. Stock is down 10.6% pre-market as of right now. If you go back out to the merger, the stock is down almost 70% since then, going to be down 75% after the market opens today. Looking at the earnings, David Zaslav is getting a lot of money, but investors are not. This guy is a pretty mediocre CEO. His decisions have not been popular with fans of WBD, fans of their content, and obviously they're not driving good returns for investors. So why is he still here? There's talk about splitting up the company. Probably not going to happen, but there's been some rumors about, hey, we're going to put the direct-to-consumer and studios segment into one business, the legacy networks into another. Who knows if that'll happen? Probably makes it difficult to really negotiate as a whole around content and all of that stuff. Some talk about spinning off their video game division, selling off some European channels, all that nonsense. But what really matters is results are bad. Q2 revenues down 5%. The market expected closer to 3%, so shrinking faster than expected. The legacy business, it's kind of a melting ice cube, and it's melting faster than anybody expected, and that's why the stock is down as much as it is. Net loss of negative 10 billion, and that looks really bad. It's like, wow, they lost so much money. I'm sure there's going to be articles around negative 10 billion and how this CEO is the worst ever. And he's, if this was the Olympics of bad CEOs, he'd probably be at least be in the final of the 100-meter dash. He's really getting there. I'm kind of hoping they replace him, but I really doubt that happens. That does include a $9.1 billion non-cash goodwill impairment charge. What does that mean? Well, when they combined, they expected this business to have $52 billion in revenue, $14 billion in adjusted EBITDA, and $15 billion in direct-to-consumer revenues by 2023. Actually, they had $41 billion in revenue, so just a small $14 billion miss. Way to go, David Zaslav. Direct consumers, $10 billion versus $15 billion expected, just $5 billion off, not a big deal. $10 billion against $13 billion on just the EBITDA side. What's a couple billion between friends? And then as you look at the valuation of that combined business, of the merged business they put on the balance sheet, 34 billion in goodwill, probably not worth that now that it's actually, way worse than they expected. So that's what the impairment charge is for. They're sort of looking at their legacy business potentially losing the NBA rights, what that's going to mean around their affiliate fees that they're going to get without the NBA, continued softness in the advertising market, and basically saying that, hey, this business isn't worth what it is shown as on the book, so we're changing that. So what's the thesis here been? Well, I sort of knew this was a shrinking business, but the thesis was going to be that legacy media would shrink slowly, direct consumer would grow a little bit and maybe faster eventually to offset that. In the meantime, they would continue generating free cash flow, pay down their debt because they still have about $40 billion worth of gross debt, and eventually the market will reevaluate this as a new business. Well, the reality is that legacy media is shrinking faster than expected. We'll look at that in a second. Direct-to-consumer isn't growing anywhere fast enough, and this business is struggling, which is why the stock price is where it is. Not a huge surprise. Yes, there's some potential positives they're going to highlight. 3.6 million net ads on the direct-to-consumer side. Sure, that's great. But it doesn't offset the fact that your revenue is down 6%, that your adjusted EBITDA is down 16%, that your free cash flow is almost halved. And again, quarter over quarter, free cash flow is going to vary, but overall, this means that free cash flow is probably going to be down for the year. They're not giving any sort of guidance for the next year, not any sort of guidance for 2025, so you don't know what's really going to happen in Q3, not really talking about the NBA and what that means for affiliate fees or anything like that. So it's kind of a black hole of information from the earnings call. Not a great earnings call. Again, they're still paying down debt, they're still generating free cash flow, paid down 1.8 billion in Q2. They still have about 41 billion in gross debt, 3.6 billion in cash. Their debt doesn't have a very high yield, which is a good thing. They're able to repurchase 3.4 billion in debt through a tender offer for 2.6 billion because people are willing to sell their debt. It's worth less now that the yields have risen and these are locked in. Their debt has a pretty long-term cycle, so I'm not super worried about this going out of business anytime soon, but the thesis is changing a little bit, certainly getting a bit worse. And as we look at some of these segments, studios down 5%. Going to be some volatility depending on releases. Games were strong last year, really poor this year. Hogwarts Legacy was a hit. Suicide Squad, not a hit. Theatrical doing well, but overall this is volatile, but still producing positive adjusted EBITDA. Then you've got networks. Again, distribution down 9%, advertising down 10%, total revenues down 8%, adjusted EBITDA down 8%. So when you've got your cash flow machine being down 8%, that is not a good sign. They talked about advertising being soft, and a lot of that stems from the fact that some of these streaming players have released ad-supported services that are driving down the cost of advertising in a big way, and that's just the new norm. I think that continues. That's a concern for a company like WBD. I talked about that in my Roku video. I sort of mentioned that in my prior WBD video as well. Then you've got distribution, which is, again, these affiliate fees. People are canceling cable. That's going to continue. That's not going to stop anytime soon, but I think it's happening faster than investors expected. That's why the stock is down as much as it is. And that means that their affiliate rates are coming down, their affiliate fees are coming down. The question is always going to be, as they go into future negotiations, if they lose the NBA, what does that mean for their affiliate rates that they're going to be able to get? I would expect that, if you go negotiate with Comcast and say, hey, you used to pay us $2 a head for TNT, and now we don't have the NBA, but we've replaced it with some of these other sports, they're probably not going to say, yeah, sure, we'll pay you $2.50. They'll probably say, we'll pay you $1.50 now. How about that? And WBD might say, well, that's a no-go, but I think losing the NBA is a big negative, even if it was going to cost them a lot to keep it. We'll see what happens from the lawsuit that they have going on, but if they lose it, I don't think that is a good thing for them in the long run, because that is difficult to replace. There's only a couple of sports like that, and it's not going to be easily replaced. They can certainly spend that money on other rights, and we'll see what happens with that. They do have a direct-to-consumer segment, and the thesis here was always going to be, this is going to go quickly and replace legacy. It's not happening. It's actually down 6%. Again, some of that is due to the timing of distribution content deals between quarter over quarter, but on the distribution side, they're basically flat. So yes, they added some subscribers up to 103.3, but they actually lost subscribers domestically, which is where the majority of the money comes from. You see an ARPU of $12 versus an ARPU of 3.85 internationally. So most of the additions were international, losing subscribers domestically where they make more of their money. Not a good sign. And House of the Dragons actually launched in the latter part of this quarter, so it's disappointing that those numbers are down on the domestic side, because that is a marquee show for them. If you look at the next quarter, they do have some shows coming out. Obviously, House of the Dragons runs through the next quarter. They've got the Olympics in Europe. They're launching in more markets in Europe. They're really only in like 50% of the markets they're going to be when it's a mature business. So there's still plenty of upside here, but it's just not growing fast enough, especially domestically. And I'm worried that churn is going to be a problem, continues to be a problem. People are just going to sign up to watch House of the Dragons when it's done and then quit after a month. And I think their strategy of saving on costs by cutting back on their content slate, probably not a good thing. One of the things that came up with House of the Dragons is that they said, hey, you have to cut back your episode count from 10 to 8 this season, and people weren't very happy with the finale of that season. I thought it was pretty good, but it was kind of didn't feel like a finale is basically what happened. So content is important when you compete against Netflix, when you compete against all these other players. Netflix has a ton of content out there. It's very easy to just say, I'm just going to sign up for Netflix. That's going to be my main thing. That's why they're the leader. They have the most content. They're spending a good amount of money on content. HBO certainly is as well. But when you hear about all of these things, about cutting back on expenses, about canceling things, about putting movies in the vault just to write them down, doesn't sit well with fans. And maybe long term, that's not the best strategy here. Maybe Zaslav certainly has a short-term perspective when it comes to generating free cash flow just to pay down debt. But from a long-term perspective, is that a good thing? So overall, not super happy with these earnings as an investor. Looking at the valuation here, disclaimer, video is purely for informational, educational, entertainment purposes only. It is not investment advice. Again, this is a company that's getting a really poor valuation from the market for obvious reasons. The business that's shrinking. When I looked at this after Q1, my expectations were a bit better than what I'm baking in here. I'm baking in negative 4% growth for 24, maybe slightly lesser growth going into the next couple of years, but I wouldn't expect this to start growing anytime soon. Legacy is shrinking way faster than direct to consumer. I think it's going to take them a while to get back to actual growth, and that's not a good sign for investors. I think they can improve margins again as DTC rolls out, to more markets. Their costs of rollouts are going to come down. That's going to start being profitable, even if the ice cube that is the legacy media business starts melting fast. It's still a possibility that their margins overall improve. Again, this is a business that had margins in the 20% plus range before the merger, Discovery that is. So it's a much different landscape today, but I think they need to work on getting that DTC business into profitability stat and making sure that revenue doesn't shrink too quickly because they eventually have to start growing again for the market to reward them. However, even with this, again, getting a 25% free cash flow yield on a next 12-month basis, about 8% on an enterprise value basis. When I looked at this last time, I kind of put everything into the free cash flow yield, 16% free cash flow yield bucket. Seems fair to me. The whole thesis here has always been, hey, they have an enterprise value of X. That includes a ton of debt. Once that debt starts getting paid down, some of that is going to float over into the market cap. So even if the market says that, hey, we're going to keep this at an enterprise value of $58 billion, but during that period, they pay down about $10 billion worth of debt. Now your market cap, in theory, is going to be about 28 billion. And if you look at that on a free cash flow yield basis, kind of gets me to that 16% free cash flow yield range. That's just sort of my thinking behind the target here. So you may think to yourself, well, it's getting a 24% free cash flow yield on a next 12-month basis. Why are you improving that in the future? Well, it's because they have much less debt, a much less risky company. You can go the other way too, at a 16% free cash flow yield, an expected return based on these assumptions. You can play with these assumptions as well, hit file and make a copy, gets you to a 7.1% free cash flow expected return. If you go to 20%, you get a expected return of about 2%. If you go to 32%, you get a negative 8% expected return on an annual basis. If you're much more optimistic than I am and you say that, hey, this should be getting an 8% free cash flow yield, then you're getting a 24% target return on an annual basis. Really doubt that happens, but that's certainly the case. A couple of things to note here. They are issuing stock-based compensation, so keep that in mind. Don't know the strike prices of those RSUs, those options, but there's potential for some dilution here, which isn't great at this lowest stock price. I have a negative 10% buyback put in here to account for that, so it's a negative buyback yield. One thing I could see them doing, again, they are generating free cash flow. If they feel like that's going to be consistent for the next couple of years and they feel like they start getting a good handle on their debt, maybe institute a small buyback. Likely not going to happen, but if they really believe that they're truly, truly undervalued, put your money where your mouth is and institute a small buyback. Say that we have more than enough free cash flow generation to cover our debt. We're not worried about that. Let's buy back $500 million worth of share every single year and start returning money to shareholders somehow and get a better handle of our business that way. Show them that we believe in the business long term, that we believe we have the capacity to pay down debt, because the debt is certainly a lot better now than it was 2 years ago. They've paid down quite a bit of this debt, more than 10 million already, and they continue to do so in the next couple of years. I think by 25, 26, this debt is going to be closer to that 29 billion that I laid out just a second ago. So as you look at this valuation at 16%, if I'm putting in a target return of about 10%, gets me to a fair value of 677, not too far off of where it's trading today. If I put in a 15% target return, I get a 542. So I think the fair value based on these earnings has come down versus what I had it when I did my last video. When I did that video, I said, am I buying more? No, because I want to see where this business is going. I want to see at least a trend of a turnaround time. And if anything, it just got worse. So am I buying more now that it's a lower price? No, because things have gotten worse. I already have a position here. I'm perfectly okay just holding it because I do think there's some long-term upside if the market continues to see them paying down debt, if they continue to generate free cash flow year over year over year, even if they're shrinking, and eventually show some sign of turnaround potential that, hey, direct-to-consumer is finally growing pretty quickly. Legacy is starting to shrink a bit less than it used to because eventually maybe it'll normalize at a certain level. Then this could really shoot off and be way higher than it's trading at today. But I also see this in the reverse. Q3 comes in, it's not good again. The stock price could easily be trading in that, target return 15% range, in the $5 range pretty quickly. Wouldn't be surprised if that happens because this is an industry that is in transition which is their word, but also in turmoil, which is my word. It's going to take a while to transition to where they need to be. And between today and when that happens, that could be years and years and years away. This is a thing where I think people expected this transition to happen by 25, by 26. But based on these earnings, I think we're looking at a transition that takes us well into the latter part of this decade, because the legacy business will continue shrinking and the direct to consumer business is so competitive now. All of these bundles may help. All of these, there's a sports bundle with Venue. There's a bundle with Disney and Hulu. Some of those things may help. They may help with churn. But until I see that, I'm just going to hold on to what I have. And again, if this stock drops to $4 or $3 or something like that, would I take up my stake? Totally. I'd be like, yeah, whatever. The upside is way higher than the downside in that regard. But right now, I just don't think we're at a spot where this business is clear enough, the trajectory of this business is clear enough for this to be a really good investment. However, I'm perfectly content with holding it, because I think as long as they keep paying down debt, as long as they keep generating, $4 to $5 billion worth of free cash flow every single year, this could be, a long-term, low teens to mid-teens annual return from today's prices. But them not giving us any guidance for 24, no insight into 25, the uncertainty around affiliate fees, losing the NBA, etc., that certainly gives me a lot more pause than I used to have just, a year ago. So that's my thought on WBD. What do you think? Is David Zaslav the worst CEO out there, or are some of the CEOs of some of the SPACs that launched 2 years ago and are now completely bankrupt worse? Probably those guys are a bit worse, but David Zaslav certainly isn't the best, certainly not showing up in the results. Wouldn't be very unhappy if they decided to go elsewhere. Not sure that happens, but this business is a business that's sort of all over the place. The games division is up for sale. It's not up for sale. They're focusing on marquee games. They're focusing on not marquee games. They're spending money on movies. They're not spending money on movies. They're cutting back on content. Content is key to drive it. They're putting all of these shows under the Max brand. Now it's an HBO original. So it's like, make a decision, stick with it. Stop making bad decisions, because you've made a bunch of them in the last couple of years, and get this business on the right foot. And I'm just not sure that David Zaslav is the CEO to do that. Next key thing that comes out for their studio business is, hey, what are they doing with the DC cinematic business? If Superman Legacy comes out and it's a big hit, that changes things a bit for the studio business. If it's not, then I don't know where they go from there. They certainly have some properties that are good, but hey, if they can't make DC work outside of Batman, because Joker will probably do okay, then they've got a bit of a problem. So let me know your thoughts. Leave a comment down below. Like the video if you liked it. Subscribe if you're new here. Thanks for watching. Bye.